Alright guys, what we're talking about today is an introduction to technical analysis. Now before I start, as always, I need to read a risk warning. Now spread betting and CFD trading both carry a high level of risk to your capital with a possibility of losing more than your initial investment. These products may be suitable for all investors and only intended for people of age 18. Please ensure that you're fully aware of the risks involved and necessary seek independent financial advice. Okay, so what is technical analysis? Now technical analysis tries to evaluate and predict the future price of security using the insights that we've had to make better decisions when trading. So with technical analysis, we try to detect the trends, the patterns of movements, using our indicators such as historical price, volumes, money flow, and many other things. So again, we can get quite in depth with technical analysis, but again, just remember, this is just an introduction to technical analysis. There will be some later presentations, some much more sophisticated oscillators and things like candlestick formations. So when we talk about technical analysis, we're really talking about an introduction. We're talking about our charts. So what charts are available, how to read them, what are support and resistance lines, and what are our trend lines. So really the very basics of how we put together any basic chart and what this information shows us. And then again, how we can refine our entry points, pick out our exit points, and how these graphs make up what we generally trade from. So again, discounting any fundamental news. We're just looking at the physical, graphical representation of what's being traded through our charts. So to establish a common language, now when we talk about securities, we're really talking about any kind of trading instrument. So we speak about things about our equities, our indexes, commodities, bonds, or gilts. When we talk about bear markets, obviously we're well aware of what they are. So when there's more sellers in the market than there are buyers, then the market is experiencing a downtrend. So again, that ties in with any kind of hawkish signals that any kind of market commentators are saying. That's the same as a bear market. Then bullish is again the very opposite. So there's more buyers in the markets than there are sellers. Okay, so we've just finished our bull market. So then again, we have a sideways market, and that's really when there's no definitive trend in the market. We do see that from time to time in quiet periods where there's really a level of support and resistance, and we move in a wave fashion. So again, very okay, now our next thing we're going to look at is a signal, so an indicator given by a specific indicator that might suggest a specific type of trend. Okay, charts. So why should we use charts? Well, the most simple answer to this is that charts are the most popular tool when it comes to financial trading. So it doesn't matter if you're trading on a spread betting system, you're trading in a bank, you're a hedge fund trader. At some point, you are going to look at the chart. It's as simple as that. Now, again, I've traded many traders over the years, and charts where you should feel very, very comfortable. They really are the kind of cornerstone of of how you build up a picture of what's happening in any kind of market. And the great thing about charts is that in all their essence, they're all set out the same. Okay, so financial charts, the x-axis is always going to be the time, and the y-axis is always going to be the price or the value. So again, we can compare different markets, different trading conditions quite easily just by looking at the two different types of charts, because again, essentially, they'll be plotting in a different way, but they will be built up in the same way. So these are our charts. So this is quite an easy example of a bearish line chart. So again, we're starting on the high side on the left, moving down to a low side on the right. So as in all charts, what we see is the actual description line. So that is what we actually, the actual price of whatever security, commodity, etc. that we're trading. And then again, at the bottom, we do see our time scales. This particular one is represented in hours. And again, this is the price value on the right-hand side. So again, this is just an indication of UK shares, of course, some time back from 5,100 to 5,950. So again, it starts to build up a fairly simple picture of what any kind of chart should really kind of look like. Okay, I'm just saying we should refresh the cam one more time. Okay. Okay, so that's back on now. That should be refreshed. So we should be seeing a line chart, the price value. Okay, and then we use these buttons in the top and the bottom left, should I say, to use our special indicators. So to overlay any trend lines or any oscillators. So again, when we look at any kind of charts, they all work in the same kind of way. We're all designed to get support resistance lines, to trend lines, use our Fibonacci retracements. Okay? So when we talk about chart types, again, the main three we're going to look at today is our line charts, our bar charts, and candlestick charts. So again, we're only talking about an introduction to technical analysis, fairly basic thing. So when we look at a line chart, this really just represents the overall direction of the chart, and it is over a specific time frame. So what we'll get to see is the open price, the close price. Okay, they're fairly self-explanatory, and the highest and the lowest. So again, these are the peaks of the value during that specific time frame that was hit. So our bar chart, that really just combines all these things together and makes it in quite an easy, simple way to look. All these time frames are actually one bar. Then we have our candlestick, so it's very, very similar, but we just use the shaped body in different colours to indicate how our charts are forming. So again, we look at our line chart here. We can see that this line represents the close price for the UK 100 at 10.30, and we can see where the actual last price was traded. So again, when you move your mouse, you can view all the same values over the time frame. So any kind of good piece of software like we're using with the integrated charts will show you the high, the lows, the open, the close at any period that we drag over this mouse on this time frame line. So again, this is when we see our bar chart. So this is just showing us the same direction of the market, but in much more detail. So what we do get to see is that we get to see that, again, this represents this individual time frame. So whatever we set that time frame to is what will be each individual bar is. So again, this is a 15-minute bar. Each one of these bars will represent 15 minutes worth of trading in that time period. So what we do is we look at the bars and we can hover over the top, and we can see that the top of the bar is the highest price traded during this time frame. The bottom of the bar is the lowest price traded at the time frame. Okay, the horizontal line that sticks out from the left is the opening price, and the one on the right hand side shows us the closing price. Now all these are very important because they show us, again, the trading volume and volatility of that particular period. So again, the bigger the bar, the bigger the candle, the more trading activity has happened, the more prices have been traded. But what also it tells us is we can draw and match up these points, the highs and the lows, of the opens and the closes. And this is what we really attach our trend lines and our levels of support and resistance to. Because again, as we know, the more trend lines that we draw in, the better kind of picture we're going to have of where the market could move in these time frames. But also, the more times they hit, the more times they correlate, it means the stronger the overall trend, or the stronger the overall point of resistance support will be. So again, very important we start to understand the basics of building up our charts, of how we actually draw these technical lines in and why we're doing it. And it's all to get correlations between the highs and lows, the opens and the closes. And remember, the time frames are very important because you get more correlations on a small time frame, i.e. a 3-minute bar, because that'll be made up in an hourly chart, several times, whereas a 15-minute bar, you're only going to see 4 of these produced every hour. So again, why I like to teach trading is that when we're drawing our basic levels of support and resistance in, we start on our dailies. Okay, so we match with as many daily levels, highs and lows, open, close as we can. Then we take it down. We take it down to maybe our hourlies and maybe our 15-minute to build up trends within that time period. And then we can use our smaller time frames, maybe our minute, maybe our 3-minute candlesticks or bars, big entry point. So this is how we build up a simple chart that gives us a lot more information than just by looking at individual bars and candles on their own. So again, when we see our candlestick chart, this is just exactly the same as the line chart and the bar chart. But what it does give us is an instant representation by seeing these colours of what buying and selling actions happen. So again, it's quite simple, isn't it? So again, when we're looking at our line chart, we just see that that's a downward move and there could be an opportunity to sell. But already when we're looking at a candlestick chart, we can begin to pick out patterns. We begin to pick out sustained levels of selling. So quite near the beginning of the graph, we see 2 red candles. We see a bit of consolidation and 3 quite large red candles that indicate people want to sell that market. So that's how we start to build up a better picture and analyze and use more information from the same information just represented in a more clear way. So the candlestick charts, again, they represent the time frame of whatever period we've set. So, I'm not going to make it any more obvious than it is, that we know that the top of the body is the opening price. The low of the body, which is shaped as the candle, is the closing price. Then obviously, because we're describing it as a candle, the wick, yeah, that's the bit that sticks out the top and the bottom. Well, the high of the wick is the highest price traded, and then the low of the wick is the lowest price traded. So again, makes it very, very simple to understand that we see this red candle, for instance, has been quite a sustained buying and selling, quite a sustained selling action, should we say, because the body is quite large and mainly red. When we see a long wick with only a little body, then we see that high prices have been hit and traded, but not continuously traded until we get back into the body. So that can mean we've got different spikes. It will mean that we've seen volatility come to the market, but not sustained, as in the prices are being gapped through and hitting high points and low points. So again, that shows us a different piece of information. If we see this one here, for instance, we see just in the first third of the chart, right where the low point is, where we've got the small hammer, then we've got the quite large red candle. So we see there's a very small body and a very long wick. That shows indecision in the market, and at that point we see a reversal, and buying action comes back into the market. So again, it's all about building up your candlestick patterns, formations, how the market is actually physically trading in these time periods. So that can give you much more accurate information than just knowing highs and lows and that a market is on a bear move or a bull move. So again, it's just how you interpret the information and how you look at it. So again, as we've said, the bigger the tips indicate the more volatile. So the bigger the body, the actual physical body, that means the more sustained buying or selling action we have seen in that time frame. So support and resistance. Now, support and resistance are pretty much key when we talk about any kind of trading, doesn't matter if it's a commodity, doesn't matter if it's an indices, an individual equity. At some point, there will be points that correlate and correspond to supply and resistance. Okay, so support and resistance, should I say. And this all comes and ties into supply and demand. So again, lines of support and resistance occur when people see value. Yeah. So people, when they're buying the market, they will look to see these points hit, because that means there should be some sort of decision coming into the market. So we're looking for points of resistance on the high side. If it's a buying market, then we look for these levels to be broken through and then maintain that we've got a buying emphasis in the market. And then on the low side, when people are selling, we look for these levels of support to be broken through. But that's again when I heard in the last presentation that the previous commentator said about the trend is your friend. Now, I do agree with that to a large extent, but this is how we understand, and this is how we can build up in our mind when it is right to go with the trend and when it isn't. So again, if you're getting levels that are broken through on the downside, it's a downward selling market, then that's confirming that the trend is continuing. When we see large bounces on the low side and we hit these levels of support and the market buys up, then again, that's telling us we're not entirely in a bearish move. We might be in a bit of a sideways move. So it's identifying what trend we're in and what particular market factors are working to that point. So again, it's very, very important to know how the markets are trading and to understand what cycle you're in, because yeah, the trend is generally always your friend. But if you can find points to bounce off, levels of support, levels of resistance, and use these, then you can make a lot more out of the trade, yeah, rather than just going with the overall trend as it is and just trying to hold it as long as you can. You can use these points to get out, use as exit points. And that's very important, especially when markets moving very quickly. You can see lots of profits swallowed up by not knowing where the market is looking to stop or where the market is looking to bounce. So again, it's just an example of it could be anything, it doesn't matter. It's just, an example of a chart. So, okay, we're going to call this Vodafone shares 2004, 2005. That's fine, that's no problem at all. So again, when we talk about drawing in trend lines, they don't always have to be as amazingly accurate as people think. You can draw these in with the naked eye. Now, as long as they're going to hit 2 or 3 points along that support line, along the bottom of these peaks, then you can call that a level of support. So again, people can get quite fussy, I suppose, that, that you have to have X amount of points hitting a level of support for it to be valid. And that's fine, but remember, you're trading against other people. You're trading against other people that are looking at these charts, drawing their own conclusions and drawing their own lines in. So you have to make sure that, again, we're following the market sentiment. That when we say that the trend is your friend and the market is a self-fulfilling prophecy, if we find a perfect level that nobody else has ever seen, then who else is really going to be trading that level? So it's always good to put in levels of support that other people have identified and other people have seen that there's value. So again, we do see some breaks through these levels of support, but generally what we see is a bit of a wave and a sideways movement and a bouncing action. That we're seeing that below that point, there are no sellers really willing to push it any further. So what we're doing is we see at that point that weakness comes into that particular downward move. We see it bounce up, and there are more buyers willing to buy these up at that particular point along that level of support. So again, it's just everything is valid. It just depends how you look at it. So again, we can use a similar example for this red line as a line of support. So okay, towards the beginning of the graph, we see head and shoulders build up, but mainly after that, we break through, we hit our level of support, the blue line, and then we look for the market to hit the level of resistance. And we do see some small breakouts, but in the main, that when we do start to come back into the red line, it gets forced straight away back down to that level of support. So instead of just identifying that we could maybe trade once, twice, 3 times, in all fairness, every time we broke above this red level or came back in, that could be 5, 6, 7, 8, 9 times that we could then sell into weakness. And then again, we know exactly where the market's going to go to, a level of support, so we can hold on to that until that's tested. So that just shows that a sideways market, although it's got no particular direction, that could be 5 or 6 times on the upside we could sell into it, and then 5 or 6 times on the downside we could buy into this particular trend. So we could have traded 12 times and 12 opportunities that we know where the market should go to. So again, it's quite important that we don't discount sideways markets and just think that, well, if it isn't going up or it isn't going down, we can't make money. You can always make money in markets if you understand the points we're moving between. This is very important. We can establish levels of support and resistance and make sure we understand where the market's going to go and therefore trade in the correct way. So again, what we see at the end of this particular cycle towards the end of June, we see a break up through this level of support, and it doesn't really ever look back. So that means we've started a new kind of trend. Now again, it's not really a perfect upward trend. It's more that we see a spike up that could have been due to maybe some fundamental news, or we could have had, I don't know, maybe there was a takeover or some record profit earnings. And then again, we do see a spike up, we see another kind of peak hit, and then we come back to within a range. So again, that's just a higher level of price trading in the same kind of style. So that really is going to bring us on to our next quite nice point, that can support equal resistance. So again, these are always points of attraction. Once they've been classed as levels of support, once they're broken through, doesn't mean they're not useful anymore. They can equal resistance. Okay, so we can indicate this quite clearly by these AT&T shares on the next chart. So as we see, a similar sideways movement that we saw before. Doesn't matter about the time periods, we're just looking at the graphs. And we can draw in, again, 2 quite good parallel support lines and resistance lines. So again, our blue level of support towards the beginning, we do see a breakthrough. But then after that, we see that 1, 2, 3, 4, 5, maybe 6 points along this blue line. You see support come into the market, and it's pushed. The buyers push it up towards the top end of the level of resistance. And again, we see that is now a good trading channel, that we can pick our points of exit on the low points. Our levels of entry on the low points and our levels of exit on the high points, and vice versa, because we don't see any sustained breakthrough on this sideways movement. What we do see when we do actually come to the end of this trading particular channel, when we do break through the level of resistance, that red line there, that we see that the price action changes, and then we do see quite a sharp upward movement. But then we do see the market break straight back down. And where does it head to? Well, our lowest point suddenly bounces off that level of resistance we'd initially identified. So that red level of resistance has now become the new trading level of support. So again, we see some nice areas to buy in this new higher trading and price bracket. So again, it's always worth keeping a note of our levels, even when they've been broken, because there still will be levels of interest to people. So once people have drawn a line in, they do get quite attached to them. So even when they are broke through, they're still valid, and it's always worth keeping in mind your levels of support and resistance and writing them down, because they will get hit at some point again. This is just the market moving waves, and they go up and they go down. So markets are always looking for information that we've had before. So again, it's all about building up your charts and just keeping a wide enough breadth of information to know what's happened in the past, and therefore what could happen in the future. So that new term is when we see that the resistance line is broken. We call that a breakout. So it's broke out of that particular trend, and it's formed a new sideways movement above, and where our level of resistance was, that is our new support. So support and resistance summary. Okay, so it's important to identify support and resistance levels. Although they're not always accurate in breakdowns and breakouts can occur, they're useful at limiting losses. Okay, so it's just another way to look at it. It's giving you a point of attraction. That's how I look at them. They're a level of interest, and that they're making the markets move. And it doesn't matter if it's on the upside or the downside, they will still be relevant as long as other people have looked at them before. Alright? So the benefits, okay? Securities do have a tendency to stay within support and resistance, but for periods of time. This is just the way the markets move. Right? Remember, we have a lot of people trading a lot of different types of information. So support and resistance lines are key. They will always, the drawbacks are, they will always at some point break out. But this doesn't matter. As long as, we've traded enough opportunities and banked money, when they do break out, we can identify it as a breakout. We can therefore go with the trend, go with the momentum. Yeah, it's just identifying the right trend, the right trade at the right time, and then going with it. That's the whole point of trading with the trend, identifying which trend you're in. There's no point trying to buy in a selling market and trying to pick these great levels of support when they're getting broke through. And that's not intelligent trading. So again, it's just trading with the right type of trading environment and making sure we're identifying it. And that's what we're going to do by drawing our levels of support and resistance and then trading the charts against that. So trend lines, as we said, when two or more points are connected, then that really creates a trend line. Okay, so we can use this to predict future prices. Okay, so it's one of the primary tools when we're looking at bear or bull markets to understand what type of market we're trading in. So uptrends. So this is when we see two low points on a chart connecting. Yep, and this really is showing an uptrend. So it'll be from a low point on the left-hand side to a high point on the right-hand side. So we can, again, easily indicate this with some Apple shares. So on the low left-hand side, okay, it's back from 2006-07. We see we can draw a trend line here. This blue line connecting two, maybe 3 points, roughly again a 45-degree angle, and that's showing as we're in an upward trend. So at any point along that blue line, we're going to find further value, be able to buy, and the market should rise from that point. Now again, a little bit further on, we see that we could draw a steeper blue line, which is a steeper line of support. Now it's not to say that's not as valid, but we see that it isn't quite as neat. Okay, so we do see some breakthroughs, and it is quite a bit of a sharper angle. So the sharper the angle, the faster the price is going to move. But the faster it moves also means if it does break through this steeper angle, the quicker it's going to break through. And at the end of that blue line, we see it broken through, and we do see a sustained buying action come into the markets. But again, if we've bought mainly along these blue lines, we've not taken on too much downside risk, and the markets have risen from there. They're good opportunities to buy. So we've identified as a bull market, we've identified levels of support, we're buying along there, and we're buying low, selling it high, and making money. Yeah? So that's trading. That's what it's all about. So again, when we see that the level of, at the end of this last line of support, should I say, we see a breakthrough, then again, when the market does start to recover, it looks to get towards a parallel line. So the last low point, we do see some resistance and some support and broke through. We could draw a straight blue line across there. Then we start to see the market trend in this higher range. So again, it's just all about identifying the trend at that particular point and then trading intelligently around that. So downtrend line. So again, this is when we can connect 2 points to the high peaks of the graph, and with that displays a negative slope. So again, that'll be high on the left-hand side, to low on the right hand side. So again, we can just look at some Barclays shares to quite quickly and easily indicate this. So again, we're looking for the tops of the candles of the bars, so we can draw that as our red line. Okay, that's our levels of resistance. So in points, a hit of the levels of resistance, we see 1, 2, 3, maybe 4 points exactly touch it. Yep, and then we move back down into that range and head towards the blue line, which is our level of support. So again, what we see is that our level of resistance, yep, that we see that when we draw in this, again, at a roughly 45-degree angle, yeah, along our tops, it's not entirely perfect because it's not hitting at 2 points, but it is a 45-degree angle, and then at most periods, when we do trade up towards this blue line, we do see a sell-off. That's what I'm saying, you don't have to be completely perfect with these levels. It can just give you an indication. You can tie this in with other oscillators, your RSI, your horizontal and vertical trend lines, etc., etc. So it's just to give you an indication that the market has moved out of this sideways trend. We are moving lower. So at any point towards the high side of these blue lines, it's going to be fair value, and you should be able to sell it down and make a profit. So again, at the end, the 45 degrees is quite important. But then again, we see that towards the end of the light blue line, we could draw in this quite steeper dark blue line, which hits the point of the graph quite a bit better, and it fits in better. Okay, it's not 45 degrees, but every high point there that we see no attempt to break through, and the market sells back down. Okay? So it's quite important to note when using your trend lines about setting the time scale. So it's very easy to kind of draw accurate trend lines when the time periods are quite low. So if you're using a 2 or 3 minute candle or bar formation, for instance, then there will be more points, more physical points that can match up. So it doesn't mean that it's stronger. It just means that there's more time frames, more time periods to match up against. So when you're using any kind of trend or any kind of horizontal trend line, then again, try and use, as I said to you before, some of your hourly or daily levels and try and find out, because there'll be less high and low points on a daily, okay, than there will on a smaller time frame. So start as far out as you can, maybe even your weeklies, and pick out the overall fundamental, outlying levels of support and resistance. Then bring your charts in to a smaller time increment. And the more you do this, the bigger picture you're going to have. So you can see the extremities of the market, how far if they did actually break out, how far they could go. Yeah, and again, it's all about knowing where the markets are going to go and how they're going to get there. So they'll all build up in different ways. Again, that could be our sideways trend going to a breakout. It could be a steady bull move that we see low side, on the left side, high side to the right side, or a bearish move, fairly high on the left hand side to a low point on the right hand side. But it's building up that picture, then using these things to trade from. So once we know where the market is, then we draw our trend lines into where the market could go. Then we're looking for the market to build up this picture, then indicators to us how the market could get there. So that's how we use our smaller time frames, our oscillators, and our different bits of market information to get our entry point. So again, it's all about building up the bigger picture, letting the time scales go smaller to picking our entry points and trying to home and refine where's the best place to get in. So again, when we say about validation, it really is a good place to start with 2 points that do connect to each other. And then obviously if there's a third or a fourth point, it's going to be even more stronger. But again, you don't have to be too rigid. Sometimes you can use trend lines as a guideline to see where the market will find and will peak out and lose momentum. And again, when you do find these perfect trend lines that hit and match up on the hourlies and then tend to match up with smaller time frames, and that's just reconfirming what we've already found out, what we've already found from these pictures. So again, it's all about building up pictures and taking what we can out from the charts. Because from a 2 minute chart, we'll tell a very different picture from an hourly chart. So again, it's about finding the trends that work for us and then applying that to the market, be it upward, downward, or sideways, and then trading off the back of it. So really, in summary, trend lines are a useful tool when they're used in the right way. Okay? You always must be cautious of using them and appreciate that trend line merely represents one tool in a very extensive suite of tools that we use. Okay, so not just completely one thing we can trade off. Yeah, they're a good indicator that will show us levels of importance, levels of direction, and levels of support and resistance. But they're not the only thing in our armory. We have to look at things like volume, look at things like our moving averages. Again, what I tend to use with any kind of candlestick pattern is Bollinger Bands. Very, very important that they can give you an indication of the highs and lows of moves. They also should marry up quite nicely with the direction of the market. We've got our moving average in the middle of the Bollinger Bands anyway, so it's very important we always look at the moving average. And again, what we can use from these techniques together is to build a picture of the market, and not just how it's forming, but where it's going to go and how it's going to get there. And that's the ability we're going to have in trade in that particular trading period or that trading session. It might give us indicators that we clearly just would not have noticed before. So we might have looked for one trade to sell in a bear market and make one 20-tick move out of that. But we've identified our levels of support and resistance, and we've identified that it's a sideways move with a bearish bias. Then we could look to sell at maybe 3 or 4 points in that trading period, take on the same risk, but make 3 times the profit. So again, very, very important we look at the markets and trading opportunities in that way. So it's not just as cut and dried as trading off levels and of trading in that one particular time or that one particular session in the same way. We can mix it up. Yeah? Okay, well, when we know our points of resistance and our points of support, we can trade along them. And then again, cut and reverse, know when we should take our profit, know when to identify weakness, when to identify strength, and when the market conditions are turning. Alright guys, well, any questions on that? I mean, again, it's an introduction to technical analysis. It's not designed to be overly complicated. I'm sure we've all used bar charts and candlestick charts. But I think this is just a different kind of take on how we look and how we trade from these charts. That we don't always necessarily just have to look for the overall trend and go with it. That we've identified our levels of support, resistance, and our trend. We can therefore trade around it. So a trading session could offer a lot more, in a particular time frame if we look at markets this way. So we look for the highs, the points of resistance, we look for the lows, levels of support. We can trade around this and maybe make a lot more money than we would do just by trading the overall trend, looking for one big trade. So any questions at all on that, guys? I mean, it wasn't very, very technical. Again, that's why I stressed that it was an introduction to technical analysis. Currently writing a lot more material at the minute on advanced candlesticks while using oscillators. Some pretty technical stuff, to be honest. So you might find that useful in up-and-coming presentations. Okay, what about triangles? Yeah, exactly. I mean, triangles are just another pattern we can identify. Now, a triangle is just really tying up our horizontal lines and our trend lines. It's nothing more complicated than that. So triangles, again, can be used to show us not only breakouts, but parts of consolidation. So what do I think of confluences? Not particularly sure of that term, to be honest, Bookie. Do you want to just elaborate on what you mean by that? So again, and I think the main thing about technical analysis is that, we have to be just as aware as your fundamental analysis. So the technical analysis will come back to every market bit of information that we know. That the markets are trading efficiently because all the market news we know at that particular time is trading together. So people are finding points of attraction. People are buying and selling at prices because they see relative value. So when new piece of information come into the market on a fundamental bias, that's when we see the breakout of markets. Yep, so that can be bits of news events. So again, the seminar on Monday that we're doing at 4 o'clock will be on technical analysis. On fundamental analysis. So that's the other side to our technicals, is knowing that when speakers come out, like, people from the Fed, Bernanke, etc., and they do indicate there might be changes to the monetary policy or changes to government policy or the business cycle. This will filter through into the markets and make them behave in a different way. Can I show you how to draw a triangle? Okay, well, I'll just pull one of these charts back and see if we can find. Okay, I mean, this is a fairly static one, but if you look, for instance, you could draw a triangle. Let me just think the best way. If we look with the light blue line meets the dark blue line, yeah, as you can see, that's a wave pattern. Then we can draw a line from here, yeah, where the mouse is, down across here. So that would indicate almost a triangle pattern. So what you'd be looking to do, yeah, is that there should be a horizontal line here, which is going to be quite a steep one. So it's not a perfect example, to be honest. But then if we draw our line in here, matching up these points here to these points here, then what we'd be looking for of that triangle is a breakout to the upside, but if not, a breakout to the downside. And that breakout to the downside happens to coincide with this quite steep dark blue line. So a triangle is just drawing in a triangle. It's no more complicated than that. So again, it's just finding things at a 45-degree angle on the top of your peaks, then finding something at a 45-degree on the lower end of your peaks, actually meeting a point. So at that point, yeah, when we do start to break out on the upside or the downside, you should see, yeah, an indicator that the business cycle or that particular trading cycle is changing. So it breaks to the high side, we're seeing a bullish move. If it breaks to the low side, we're continuing the downward move. So it's no more difficult than just matching up the high points on the top of the graph, the low points on the bottom, making them meet somewhere. And again, if they don't meet, then it's not a valid triangle. It's not a valid indicator. If it does meet, then it is. You can't always just find out perfect examples of technical analysis. Some are left up to interpretation, and some just don't work. Some that, you'd love it to make a great pattern and for it to fit in with what you're thinking, but sometimes they don't. And if you don't try and force it. Because again, it's all about the self-fulfilling prophecy. That if you think you found a level that no one else has seen, then actually, what use is it in the market? Yeah, if no one else is looking at it, then it's not going to be validated by anybody else. There'll be no level, no people buying or selling or even looking at it. So the more people that are looking at the overall picture, the big picture like you are, and that tie in with your particular view, then the more people are going to trade around it. So again, it's just a different way of looking at how you interpret technical analysis and making sure that you're looking at the most obvious things. Because this is, again, like I said, it's an introduction. The trend lines aren't difficult. We should all know how to draw trend lines, but it's how you interpret it and how you make money from it. Okay? So it just goes to show you identified a parallel resistance and support trend channel, then all along the low side you buy, all along the high side you sell. So you might get 4 or 5 or more opportunities in that time period to make money than you would do than by not identifying that trend channel. So again, it's how you use it and build up this bigger picture and make money from it. I think that's the really important thing that a lot of people tend to miss from technical analysis. They think it's very black and white. And to some extent it is. And the markets need that. People need that reassurance that, we've got finite points of resistance and support. But they will always get tested, and they'll always get broke, and they're not always going to hold. Okay? So that's just the market nature, and that's just how anything trades. If technical analysis was so straightforward, and it always worked, then we'd always make money, wouldn't we? Because no one would ever be wrong, because we know exactly where it'd go, or exactly where it'd stop, exactly where the markets find value, and exactly where they don't. And the markets are never that clear cut, unfortunately. So if we build it up this way, we just know areas of attraction, and we know where the market could go to, and how it will be supported, and how it will be, find levels of resistance. That's where we're building up our trading knowledge, and using technical analysis to its full examples. Okay, so the break or upside is a bullish indicator. Yeah, again, we're talking about triangles, yeah. So again, triangles, they're no more than just two corresponding lines of support and resistance. Again, they're not parallel, obviously, because you can't make a triangle out of parallel lines. But you can make parallels as in the top side to a 45 degree and the bottom side to a 45 degree or whatever angle. The triangle does not have to be, an equilateral, for instance. It can be on a lower slant. You can just see. Again, this is almost a triangle in itself. We can see levels of support really kind of coming in to this level here, to where these points pick. So again, we could draw a triangle right down, carrying on this line and carrying along a straight line of support, and then we do see them break through, that could indicate a bullish or bearish continuation to the market. But I mean, to be honest, triangles are just like anything else that people try and make something more out of a triangle than they actually are. A triangle's just a straight line or two well-fitting trend lines. That's all it is. Triangles are no more great to trade from than anything else. They're just a build-up of two types of trend lines, or a mixture between your levels of support and resistance in the trend line. So that's all it is, really. Okay, how can I identify a fake break on support or resistance line? Well, a fake break will be indicated, you want to look on short time periods. So again, when we're looking at a candlestick, if we see something with a very small body and a high wick, then that's an indication that somebody's seen a level, tried to buy or sell as fast as they can to break through that level. There's not been a sustained body, so not every price is traded. So what will happen is that's a fake breakout. So that's how you identify fake breakouts, by there not being a solid body of sustained buying or selling action, and then the market does not continue to trade. It looks to get back into that particular level, that particular trend channel, or that particular level of support or resistance, and then carry on in the wave. So it breaks through and doesn't go with any momentum or any continued direction, then that's a false breakout. Simple. So again, you can identify that in quite a small time frame, your 2, your 5 minute candlestick. So it doesn't keep going through with any real direction or any real volume. Then that's a fake breakout. So, good question. Okay, guys, anything else? Any other questions we'd like to know? Again, I mean, it's with this being an introduction to technicals, it's very difficult not to, really kind of move on to the next level and show you how you can tie in highs and lows with things I mentioned, like Bollinger Bands, moving averages, your RSI, all these signals of strength, because they do all really tie in together. So this is just really how you build your frameworks. So when you first go to draw a chart, the first thing you should do is identify the previous highs and lows of days and weeks, because they'll give you a good solid point of where the market could extend to. Then draw in basic trend lines, so when you do see strength or weakness that could follow this particular direction of the market. And then again, build up, different levels within this. There's no point having levels everywhere, because they're not all going to hold. So once you've got the basic idea of the direction of the market and the highs and lows and where the market could extend to, then you look to take your time frames down and look for your perfect entry point. So if you know it's a bullish move and you know where it could possibly extend to due to the previous high of the day, of the week, then you look for your smaller time frames, your 3, 5 or 15 minute candles, to then pick an entry point and say, okay, well the market should go to here, so I need to buy around this level, to let the market go up and hit the trend lines that I've identified. Okay, so hopefully that makes sense. Alright guys, any other questions? Anything you'd like to ask? Again, we're going to go through some fundamental analysis a week today, an hour early, so it'll be 4 o'clock GMT. So very, very important we look at our fundamental news. There's lots of it out at the minute. I think we're tending to find as traders that the technicals are great, but markets are moving a lot on rumours. The market is quite thin, so they can overextend. So anything that happens in the Eurozone or the US, again, we need to be aware of what's happening. So all very interesting. Right, guys. Anything else you'd like to ask? Anything else you want to bring to the table? Any other thoughts, comments on what's happening in the markets in a minute? Again, I'll be doing the actual monthly webinar on FX Street on the 16th of February, so I hope you can join for that. That'll be a 3-hour presentation. We're talking through one of my new courses, how to trade for a living, so how to build up a trading plan, why it's so vitally important, and how this can help your trading career. So that should be quite interesting for you guys. Anything else you can help with? Anything else that people might want to bring? Okay, so resistance points of euro dollar. Can you explain as an example? Okay. Well, I can't really show any specific examples right now of any kind of currency trades, unfortunately, because the presentation I've brought is static. It's one that's been pre-prepared. So maybe in another webinar, or maybe up and coming, I can get some live data for you, or I can pull up some charts we can go through. Again, I mean, I think the key to remember is when you're drawing in your points of support and resistance, that you need to always look at your time frames. It's very important that you use your larger time frames to build up your overall picture of the market. Then you use your smaller time frames to tie in with the oscillators to pick up and to pick up your entry points. It's very, very important. Okay, so if you have different indicators meeting at a price, you have areas of confluence and it's become a stronger support resistance. Yeah, no, of course. Yeah, I mean, that's the whole point. I mean, well, when I say about, things tying up, when we're just talking about your levels of, support and resistance, they're just one thing. They're just lines, okay? So they're just worth 2 or more points of meeting. Yeah, when you get other indicators like your RSI, crossing into positive territory, or you get your Bollinger Bands indicating a peak or a trough, or, where a point's been oversold, or, okay, all these kind of things, they tie in together. So obviously, the more indicators that tie in together to show you it's a level of resistance and support, the stronger it gets. But again, very difficult to show that without going into an advanced technical analysis. This is just meant to be the very, very basics of how you build up the overall picture. Okay, can I explain stop losses and other options of how we can use it, please? Okay, well, again, I mean, the key thing is, when you're using levels of key support and resistance, then they become, in themselves, your levels to be stopped. So somebody mentioned just before that, how do we know there's a false breakout? Well, if you're getting to a key point of support, then, the majority of people have identified this, then you're going to go long, okay? So the market will look to test these lows and break people out of the trade by pushing it through a particular trend line and making it appear that it hasn't held. So when this happens, then you have to have, an intelligent risk reward in place, or an intelligent stop. So say, well, the market's moved 2%, so this could be a big level, so the market could move 30 ticks below this. So again, if it breaks 5 ticks below this, I think the market could be indicating there might be a breakout, although it may be a false breakout. So I will let that trade go no more than 10 ticks offside. I'll cut out the position, and then when the trade does break down 36, say fine, okay. But if it doesn't continue a sustained move, then I'll either buy back in at this lower price, or I'll wait for the market to retrace back up, get into the trend that I've identified, and carry on. So it's all about using intelligent risk-reward strategies and making sure you know how much you're willing to lose. So again, you can ask me, as you just have, how many stop losses can we set as an average? Set as many as you want. You're the trader. There's never a finite answer for this. What I'd say to you is that around about any kind of big key levels, like the other speaker was mentioning before, say if you're trying to hold the FTSE around 5,000, that can get broke through to any level you want and then come back within 15 minutes. Okay, because they know, the market knows people have stops in place and they know the psychology of the market. So what you have to do is identify when you're right and hold it, and when you're wrong and get out of it. Okay, so if it is such a key level and it breaks through, then just get out for whatever you class as an affordable stop loss. You can always get back into the trade. If that trade is therefore a false breakout, then get out for as small a loss as you can. Wait for the market to start trading within your trends again, and then again go with the trend, because the trend is then your friend, and it's continuing in a way you know how to trade. So many times people get stopped out of trades when they're actually right, because the market spikes down and people can't hold on to the trades. Then you have to start doing things like negatively average and, buy more at a cheaper price, and you end up taking a lot bigger positions than you wanted to. So if you hold on to your risk reward and you set it in your mind that it is the level that's going to hold, and it does break through, you get out for, a very small loss and then wait for the market to trade in your direction. Yeah, you don't have to take that pain on board. Yeah, you have to be a little bit more intelligent about trading these days, because the markets are so thin that any level can get broken, and it look like it will get, broken, and it will be sustained, and within, a very short time period, the market reverses back and trends exactly how you imagined it would. And that's just dealing with new markets, I'm afraid, and dealing with, the levels of volatility and volume we have at the minute. So it's adapting, and identifying the market conditions, as I said, and trend lines and knowing how far markets can move. That's what this is all about. Yeah? Alright guys, well, there's no other questions tonight. I think we can call that a day. There's a link already up to my future presentation. So you just, if you want to just find out the next presentation, that will be on Monday. I've got lots of things up and coming. But anything else you'd like to ask, I will send you a follow-up email, so you have my details. And it's been great, guys. Again, some great questions there. Again, I'm sorry it wasn't more technical, but again, I have to make a judgment call on what the presentation is going to involve, and this being an introduction, I don't want to make it too more complicated and too more convoluted than what it is. Okay, so the next presentation, maybe we do advanced technicals, and you can get in a bit more from that. Right, guys, well, nothing else further you want to have tonight. It's been an absolute pleasure, and I will speak to you guys next Monday. All right, have a good evening. Cheers, guys.